Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. Tuesday, July 26, 2022. Little bit to talk about today. Walmart can't get out of its own way, unfortunately. Pre-announcing last night, same concerns that they reported in the last quarter. In terms of inventory is too high, wrong mix. They are seeing good business on the grocery side of things, but not spilling over into merchandise. General merchandise is weaker. It's a more cost-conscious consumer, but at the same time, it's also some mis-execution on Walmart's part. Unbelievable. Things might be down another 10% today. Dragging down the whole retail space with it. We got Amazon looking down 4%. A lot of these stocks are looking down 2%, 3%, 4%. I don't know how much you can extrapolate this to like a Costco. A little bit different. People don't go there necessarily for general merchandise. They mostly go there, I think, for their groceries. And I've always been a superior executor. So that could be interesting, perhaps. The dollar stores, maybe on the pullback. They don't sell a ton of apparel. That's one of Walmart's biggest problems right now is the apparel line. So that could be an opportunity as well. Looking around at other stuff in retail land, Shopify cutting their workforce by 10%, stock looking down 10%. That's one of those that's still pretty expensive, even though it's gotten absolutely crushed. So that's probably still a stay away for now, I would think. Looking over in the commodity land on metals, pretty strong moves. Everything's in the green except for sad gold. But other one like copper's up 2% today. Freeport McMoRan continues to be top of mind for me. So mining and base metals, what I'm kind of wrestling with here on the base metal side. When you think about Russia, like countries are going to be less inclined to buy raw material, base metals from Russia. Europe is going to have a problem when it comes to manufacturing because of energy costs. So if you think about like aluminum or steel, what have you, like an Alcoa, Nucor over here, maybe those companies are a little bit better positioned now, and maybe that positioning lasts a little bit. Normally it would be a little early in the economic cycle, I think, to make a big play into base metals. Obviously that those do well coming out of a recession. But this could be an exception because of these dynamics going on around the world. It's interesting. So that's something to think about. We're uninvolved with the exception of Freeport. We do own a little bit of Freeport, but thinking about the other ones as well, just on that thesis. And then you look over in defense. Raytheon reported, looks like it was a little bit sleepy on top line, better bottom line, but they reiterated full year numbers. So maybe that's a buy on the dip kind of thing on the secular growth that is defense spending. And then Lockheed Martin, we talked about this before, decent, really strong orders for those guys. They reported last week, insider buying last week. Still looking at that 200-day moving average. Stock had a good move yesterday, but gave back some of it. So I'm still watching. Looking to add on LMT. And that's it. Have an awesome day. And we'll be back tomorrow with plenty more.
Some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.